If you're a UK pensioner receiving your state pension, you might be sitting on a tax bill you don't even know about. Thousands of retirees are getting unexpected letters from HMRC demanding payment, and here's the shocking part. Most of them had no idea they owed anything. Today, I'm breaking down the 7 critical pension triggers that could mean you need to file a tax return in 2025, and trust me, Number 5 catches almost everyone off guard. Welcome back to my channel, where I help you navigate the complex world of UK finances and retirement planning. I'm here to cut through the confusion and give you the straight facts you need to protect your money. If you're a pensioner or planning for retirement, this video could save you from some serious financial headaches down the line. We're diving deep into HMRC's pension tax rules for 2025, and I promise you, by the end of this video, you'll know exactly whether you need to file a tax return and how to stay on the right side of the tax man. Make sure you stick around until the end because I'll be sharing some practical tips that could save you hundreds, even thousands of pounds. Now, before we jump in, hit that subscribe button and turn on notifications so you never miss crucial financial updates that could impact your retirement. Let's start with the fundamentals, because this is where a lot of confusion begins. Many pensioners operate under the assumption that once they retire, their tax obligations become simpler or even disappear entirely. Unfortunately, that's not how the system works. Your state pension is taxable income, just like the salary you earned during your working years. The key difference is that your state pension is paid to you gross, meaning no tax is deducted at source. For the 2025 tax year, the personal allowance stands at £12,570. This is the amount you can earn before paying any income tax. Now here's where it gets interesting. The full new state pension for 2025 is approximately £11,502 per year. Notice something? That's just under your personal allowance. So if the state pension is your only income, you typically won't owe any tax. But the moment you have additional income, whether that's from a private pension, rental property, savings interest, or part-time work, you could be pushed into a taxable position. HMRC usually collects this tax through the PAYE system by adjusting your tax code on your private pension or other income sources. However, there are specific situations where this automatic system breaks down, and that's when you need to file a self-assessment tax return. The first major trigger that could require you to file a tax return involves having multiple pension incomes. If you're receiving your state pension plus one or more private or workplace pensions, the situation becomes more complex. HMRC attempts to collect the tax owed on your state pension by adjusting the tax code on your other pension sources. However, this system isn't foolproof. Problems arise when you start receiving a new pension partway through the tax year, when pension amounts fluctuate, or when Revenue and Customs doesn't have complete information about all your income sources. If your tax code hasn't been adjusted correctly and you've underpaid tax as a result, HMRC will typically send you a simple assessment letter. In many cases, they'll want you to complete a self-assessment tax return to properly calculate what you owe. This is especially common if your total pension income exceeds £20,000 annually, or if there are complications with your tax code. This trigger applies to those fortunate pensioners who continue to enjoy substantial income in retirement. If your total annual income exceeds £100,000, you must file a self-assessment tax return. This requirement exists because of the tapered personal allowance rule. For every £2 you earn above £100,000, your personal allowance is reduced by £1. Once your income reaches £125,140, your personal allowance disappears entirely. This situation often affects pensioners who have built up significant private pensions, those receiving directors' pensions from their own companies, or individuals who continue working in high-paying consultancy roles alongside drawing their pensions. The calculations become complex, and HMRC requires a formal tax return to ensure accuracy. Even if you believe your tax has been properly deducted through pay, Crossing this threshold mandates a self-assessment filing. Here's a trigger that catches many pensioners completely off guard. If you have untaxed income exceeding £2,500 in a tax year, you need to file a self-assessment return. What qualifies as untaxed income? The list is longer than you might think. Rental income from property you own is the most common example. Maybe you're renting out your former family home, or perhaps you have a buy-to-let property that's generating income. Even renting out a single room in your home beyond the rent-a-room scheme allowance counts. Interest from savings accounts is another major category, particularly now that interest rates have increased substantially. While banks and building societies deduct tax on interest above the personal savings allowance, if you're a higher rate taxpayer, you might have additional tax to pay. Other sources include dividends from shares beyond your dividend allowance, income from overseas pensions or investments, and certain types of commission or freelance income. If you're doing any consultancy work, writing, or providing services on a self-employed basis, that income needs to be declared if it exceeds the threshold. This trigger relates specifically to how you've been contributing to pensions and claiming tax relief. If you're a higher rate or additional rate taxpayer and you've made personal pension contributions, you might be entitled to additional tax relief beyond what's automatically provided. Here's how it works. When you make personal pension contributions, you receive basic rate tax relief automatically at 20%. However, if you're a higher rate taxpayer at 40% or an additional rate taxpayer at 45%, you need to claim the additional relief through a self-assessment tax return. This is the only way to recover that extra 20 or 25% relief. Some pensioners continue making pension contributions into their 70s or even 80s if they're still working or have relevant UK earnings. Others might have made significant contributions in the previous tax year and are now claiming the additional relief. If this applies to you, filing a tax return isn't just required, it's financially beneficial because you'll be claiming money back from HMRC. This is the trigger that catches almost everyone by surprise, and it's become increasingly common since pension freedoms were introduced. If you've taken money from your pension flexibly, meaning anything beyond your 25% tax-free lump sum, you might trigger a tax return requirement. When you make flexible withdrawals, your pension provider applies an emergency tax code, often resulting in significant overtaxation, particularly on your first withdrawal. While you can claim this back through HMRC's online system or specific forms, complex cases often require a self-assessment return. Additionally, if you've taken multiple withdrawals across the tax year or withdrawn from several different pension pots, calculating the correct tax becomes complicated. HMRC may request a self-assessment return to properly reconcile your pension withdrawals with your other income and ensure you've paid the right amount of tax. This is particularly common if your total income, including pension withdrawals, pushes you into a higher tax bracket, or if you've triggered the money purchase annual allowance by accessing your pension flexibly. Many pensioners have built up investments over their lifetime, whether in shares, funds, or second properties. If you've sold any assets and made a capital gain that exceeds the annual exempt amount, you need to file a tax return. For the 2025 tax year, the capital gains tax allowance is just £3,000. This low threshold means that even relatively modest investment sales can trigger a filing requirement. Sold some shares you've held for decades? Disposed of a buy-to-let property? Transferred assets that weren't to your spouse? If your gains exceed £3,000 after deducting allowable costs, HMRC wants to know about it. Property sales deserve special attention. While your main residence is usually exempt from capital gains tax through principal private residence relief, any period you rented it out, used it for business, or lived elsewhere might create a taxable gain. Second homes and investment properties are fully subject to capital gains tax, with residential property gains taxed at 18% for basic rate taxpayers and 24% for higher rate taxpayers. The final trigger involves certain state benefits that are taxable and might not have had tax properly deducted. While the state pension itself is taxable, as we discussed earlier, Other benefits can create complications. Job seekers' allowance and employment and support allowance are both taxable benefits. Carers' allowance is also taxable, and this has caused significant problems recently, with many carers unwittingly exceeding earnings limits. If you've received these benefits alongside pension income and HMRC cannot collect the tax due through your tax code, they may require a self-assessment return. Additionally, if you've received a state pension lump sum for deferred state pension, this is taxable and might require a return depending on how much tax was deducted. Ignoring the requirement to file a tax return carries serious consequences. HMRC imposes an immediate £100 penalty if your return is just 1 day late. After 3 months, additional daily penalties of £10 per day begin, up to a maximum of £900. After 6 months, another penalty of 5% of the tax due or £300, whichever is greater, is added. After 12 months, another 5% penalty applies. Beyond financial penalties, you could face interest charges on unpaid tax, potential investigation into your tax affairs, and in extreme cases, criminal prosecution for tax evasion. The stress and hassle of dealing with HM revenue and customs enforcement far outweigh the effort of simply filing on time. If any of these triggers apply to you, here's what you need to do immediately. First, check whether you're already registered for self-assessment by logging into your government gateway account. If you're not registered and believe you need to be, register as soon as possible. The deadline for registering if you have new income is the 5th of October, following the end of the tax year. Gather all your documentation, including P60s from pension providers, details of any untaxed income, records of pension contributions, and information about any capital gains or flexible pension withdrawals. Consider using HMRC's online tax tools to check your tax position, or better yet, consult with a qualified tax advisor or accountant who specializes in retirement taxation. Even if you're not sure whether you need to file, it's better to contact HM Revenue and Customs and ask rather than assume you don't need to. They can review your specific circumstances and advise whether a return is necessary. Remember, the self-assessment deadline for online filing is the 31st of January following the end of the tax year. So for the 2024 to 2025 tax year, that's the 31st of January 2026. There you have it, the 7 HMRC pension triggers that could mean you need to file a tax return in 2025. I know this can feel overwhelming, but understanding these rules puts you in control of your retirement finances and helps you avoid those nasty surprise bills from HMRC. If this video helped clarify things for you, please give it a thumbs up and share it with any fellow pensioners who might benefit from this information. Drop a comment below telling me which trigger caught you by surprise, or if you have any questions about your specific situation. Remember to subscribe and hit that notification bell so you stay updated on all the essential financial information you need for a secure retirement. Until next time, take care of your finances, stay informed, and enjoy your well-earned retirement. See you in the next video.